Today, I want to talk about why the shorts are delaying the split and what they're trying to put in place pre-split that's taking them so long. I want to show you proof these hedge funds are struggling and also tell you why Charles Payne hates short sellers. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, I want to explain two viewpoints as to why the shorts are desperately trying to delay the split. My viewpoint and Almo's viewpoint. So he tweeted saying it sure is all making sense now. It looks like the litigation being opened surrounding AMC is indeed to buy them time. So let's look at the why. So he believes it's to structure crypto in a way that Ken and his crew can set up and institutionalize blockchain in a nefarious way. And that's to mitigate their short losses over the past few years and ultimately to pay for the squeeze. Now my viewpoint is these delayed tactics are being implemented so they can create a way to pay for the squeeze, whether that's through blockchain or through a separate CBDC or through a different Fed loan program, I don't know, but I believe that's ultimately why the split is being delayed. Now before we dive further into Almo's blockchain thesis, let's talk about how we know the shorts are trying to delay the split and actually how the SEC and FINRA are trying to help them. No more Mr. Nice Guy tweeted saying, is it possible that our federal government is helping suppress the price of AMC and APE because they know it will trigger the greatest transfer of wealth the world has ever seen? And Frank added saying that Congress has gone on record to support fraud and limit swap data dissemination to the public. This is a letter from Congress to Gary Gensler, saying we write with respect to the SEC's two proposed rulemakings pertaining to security-based swaps and securities loans. In order to help the communities we represent succeed, which you'd think would be you and I, but is more than likely the hedge funds, regulators must support the US economy by promoting liquid and efficient markets. Congress is concerned that the SEC's proposal to publicly disclose positions in security-based swaps and securities loans on a loan-by-loan basis could impair market liquidity. And we believe the proposals could compromise the objectives of the SEC by releasing sensitive and potentially misleading information to the public. And in order to avoid unintended negative consequences, we encourage the Commission to adopt an approach that requires reporting solely for regulatory purposes when finalising these proposals. So basically, members of Congress do not want data around security-based swaps, aka total return swaps, and securities loans, aka margin loans, being made public. Frank added saying, how do we win against this? Don't forget that hedgies are Americans too, and Congress represents the hedgies just as much as they represent you. And when hedgies and short sellers ask for things from their representatives, those requests are usually accompanied by campaign contributions and under-the-table kickbacks. And that's likely why Congress is representing these hedgies over representing you and I, because we're not bribing those members of Congress. So we know that at least Congress and likely the SEC and FINRA are trying to help these short sellers by trying to reduce their disclosure, especially around security-based swaps and securities loans, and short selling in the past. And we also know they're effectively trying to delay the lawsuit by at least another 90 days. And Almo was wondering why a couple of shareholders during the court session stated and asked the judge in a weird way to specifically allow for the 90 days before ruling or making the decision. They gave no reason as to why they wanted the 90 days, rather just to take the 90 days in full before making any decision on the AMC conversion and reverse split. And he said, I bet if we look at the titles of new litigation or even the implementation dates of Citadel's expansion into crypto markets, it would paint a very interesting picture. And he said, I'm thinking that now would be a perfect time for litigation by retail investors against the new crypto and blockchain efforts by Ken Griffin and his crew. We know Ken Griffin and Citadel Securities are adventuring into blockchain, trying to become the #1 market maker in the crypto space, and maybe that's to generate more money to pay for the squeeze. Whether they're going to try and pay for the squeeze in a specific crypto token or specifically a CBDC, or as I suggested earlier, another additional Fed bailout loan, I don't know specifically which one. But I believe it's likely the shorts are trying to delay the lawsuit decision for an additional 90 days, so Citadel, the SEC and maybe even the Fed can put something solid into practice, and to come up with a specific form of payment to pay for the squeeze. And the reason why the shorts have decided now to figure out a way to pay for the squeeze is because of the portfolio leverage of some of these hedge funds. David tweeted saying 6 times leverage seems nuts to me, but especially with such a high assets under management. He said they might use low volume most of the time, but he said I also bet there is most likely some bad tail end risk. This extract shows the Millennium Hedge Fund has $58 billion of net assets, but has $391 billion of regulatory assets under management, giving them a leverage ratio of 6.8 times to 1. Citadel has a similar leverage ratio of 6.6 times to 1, and Point72 has a leverage ratio of 5.1 times to 1. Many of these massive hedge funds with hundreds of billions of dollars are also operating on ridiculous leverage ratios. This means on average their total short position needs to move against them by 15.62% to liquidate their entire fund. And this data comes from a LinkedIn post that says don't trust your gut, smaller hedge funds are actually safer. Now this is a pretty lengthy LinkedIn post that analyses loads and loads of different data points, and it basically summarizes by saying that actually larger hedge funds like Citadel and Point72 actually take on way more risk than smaller hedge funds. The reason why these big hedge funds like Citadel can get away with it is because they're big brand names, and tons of pension funds and tons of individuals invest into funds like Citadel because of their name. Many of those individuals and pensions investing into Citadel don't really care about their risk process, don't really care about their risk appetite, don't really care what they're doing with the money, as long as they make a couple of % at the end of the year. But it basically explains why some of these larger funds are taking crazy risks in the market with sky-high leverage ratios that are likely committing illegal crimes. As a result of them taking on such massive risk with such high leverage ratios, it basically means that when something does go wrong, it goes wrong on a massive scale, which is ultimately why likely these shorts and the Fed are trying to come up with a way to not only delay the AMC split, but to figure out a way to pay for the squeeze. And that's why this guy said there's so much action in AMC, but yet the price is locked up. He said, I'm telling you, when the real values are revealed, we're going to be so rich. He said when the shorts are forced to cover and the real values of AMC, GameStop and Avape are revealed, we will all be rewarded for our collective strength. He said the crime to keep the price down is immeasurable, but the shorts are going to pay. The amount of crime needed to keep the price of AMC suppressed is so immeasurable, it's likely that our own federal government is actually helping to suppress AMC. As I said, especially as Congress are trying to petition for less disclosure around security-based swaps and securities loans and shorting in general. They never vote for less disclosure around long positions, only for less disclosure around short positions, swaps and loans. Clearly there is something very sketchy going on that cannot be revealed. And it seems to be not just us that know the shorts are in trouble, but even the wider market knows as well. MarketBeat posted this article saying that Virtue Financial's rating has been lowered to sell at stocknews.com. It says Virtue Financial was downgraded by research analysts at stocknews.com from a hold rating to a sell rating. Clearly the market knows that Virtue's revenues and profits have been decreasing and they're on a downward trajectory and could be taking way too much risk and could potentially end up going bankrupt. Obviously, Citadel Securities isn't a listed company and therefore we don't know what the analysts think of Citadel, but we know that analysts think Virtue is a sell. And again, it's not just Virtue that's in trouble, as Bank of America is bleeding. This article says one of the most important figures in Bank of America's second quarter earnings report, due Tuesday, likely won't be included in its main press release. The size of the company's loss on its huge bond portfolio will probably be tucked into the financial supplement. The portfolio of so-called held-to-maturity securities showed a loss of $99 billion at the end of March. And based on JP Morgan's second quarter profit report released on Friday, the Bank of America's securities losses may have widened. And the economic losses in the Bank of America portfolio are real and would account for a sizable chunk of the $182 billion of tangible equity it had on March 31st. Basically, Bank of America is in massive trouble with this giant $100 billion so far unrecognized loss that they're likely going to try and hide and wrap up. It won't be part of their headline figures like revenues, profit and margins. It's going to be tucked away in that financial supplement, but that loss has likely grown. And as I've said in the past, remember that Bank of America does like 90% of the prime brokerage service for Citadel securities and offers the majority of their margin loans as well. And therefore, if Bank of America is in trouble, then so is Citadel. But finally, let's talk about Charles Payne's beef with short sellers because they squeeze with impunity. It says Making Money host Charles Payne argues short sellers have way too much latitude to create havoc in the market.
So this week, Bloomberg wrote a sympathetic article about famed short seller Andrew Left. Now, 2 years ago, the FBI showed up at his home. They seized computers and phones, and since then, Left has gone into a foxhole. He's waiting to learn if the Justice Department and the SEC will bring charges of stock manipulation to him. Meanwhile, the public anxiously is also awaiting the outcome as well, especially retail investors. They went to war against Left and all the other short sellers. And I got to be honest, I've had my beefs with short sellers for over 30 years because I think they have way too much latitude to create way too much havoc in a market that normally either has guardrails or should have guardrails. And I admit I love when they are squeezed because, well, I've seen them do a lot of squeezing with impunity. Arguably, it's all legal, but the tactics that I've seen are unfair, and if not illegal, they certainly should be curbed. Now, there should be no way, in fact, like, for instance, to borrow a stock, more stock than is in the float. And then I got to tell you the other thing. It's these smear campaigns. So yesterday, Left told Benzinga that he should be rewarded for exposing bad companies. This is what he said. He's exposing bad companies. And by the way, he talked about working all night long. I've worked day and night for 3 or 4 decades. I'm serious. But what's a bad company? By the way, on this note, folks, I want to make sure that Gary Gensler gets his note. MMTLP. Please look into that.
So guys, be sure to let me know what you think down in the comments below. And as always, guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.